Hello.
Hey guys, hope everyone's well. I see we've got a few people here. We might wait a minute or two for a few more people to rock up with a few late entries, but thanks for joining us. So we've got Kat here today and Trent. We're going to run through the seminar or the webinar, whatever you would like to call it. Let's kick off. As we've gone through, we'll be talking about affordable insurances for dual income and no kids. A lot of people will consider, why do I need insurance at this stage of my life? Two incomes, no children to look after. What happens if things go wrong? Hopefully, we'll be able to push you in the direction of why we think it's important and go from there. We'll kick off.
Okay, so this is kind of the most boring slide of our little presentation, and we need to put it in here for legal reasons, but essentially all the information here is general information only, so please don't consider it to be advice. If you need some more information, please speak to a financial advisor. Okay, so
awesome.
Agenda.
So our agenda for the night, what we're going to do is we're going to go through what we think you need if something goes wrong. So different areas of insurance and what sort of things will be required if you get sick, you're unable to work, those sort of things. We'll speak about your greatest asset, which might be a little bit different than what most people consider their greatest asset. We'll run through the types of cover that we would typically look for with the type of people we're talking to today, so the dual income with no kids. We'll talk about the covers, what you would actually need for those as well. We'll run through a few myths and a few case studies and how things actually work, the costs, and then we'll run through a few questions and answers at the end if we have any.
Amazing. So we'll start off with, what do you think you would need if something went wrong with your health, or if you were to pass away? What would happen? What would happen with your partner? If anyone wants to chuck anything in the chat, that'd be great. Otherwise, I'll move on to the next slide. I'll give it a few seconds. Any ideas at all? What do you think would be impacted? Yeah, income, definitely. That's a big one. Amazing. All right, I'll move on to the next slide. But essentially, if you were to, thanks, Danica. That's a big thing to consider as well. So if you weren't able to work, then obviously your own income is impacted. Maybe your partner might need to look after you, and that might mean they may need to take time off of work, so their income will be impacted. Maybe you'll have some large, chunky medical bills. Would you be able to have the funds to pay for that if that arises? Would you still be able to pay off your mortgage if you own your home? Or if you're still renting, would you still be able to continue paying the rent with one of your incomes being impacted? And then another thing to think about is, if you were to pass away, would you want to actually leave a legacy to your partner or any of your other family members? So these are just some of the things that we consider when we think about insurances and calculating your needs. Okay. And so we also just popped in some statistics from Zurich's cost of care white paper. So this is based on statistics they accumulated back in 2018 about different health conditions and what the average cost is. So some pretty big stats here. So for prostate cancer, I'll start with. 1 in 5 men have a chance of being diagnosed with prostate cancer before the age of 85. And that tends to have about an average lifetime cost of $36,800. Breast cancer. So 1 in 8 women have a chance of having breast cancer before 85. And the average lifetime cost of that is also around the $36,000 mark. Parkinson's disease, they found that 18% of people that are currently living with Parkinson's are of working age. So I think people have the assumption that Parkinson's only affects older people, but it does affect some younger people as well. And they found that the average cost of someone living with Parkinson's disease over 12 years added up to be about $170,000. And finally, we just popped in a stat for spinal cord injuries. So Zurich found that 80% of spinal cord injuries occur in men, as men just like to take risks and they need to calm down a bit. But if you were to suffer a spinal cord injury, the cost to you to live with that injury is more than $100,000 per year. So it can be quite expensive to have something unexpected happen to you. And this is what we like to look at insurances to help with mitigating that risk. And also just want to reiterate, we mentioned it at the beginning, but if you have any questions along the way, please feel free to pop them in the chat, because we're happy for this to be an interactive session. Okay.
Yeah, so with that as well, the prostate cancer, the breast cancer, and those other illnesses that Kat mentioned, those actual costs don't take into consideration the income that you would have lost throughout that period as well. It's basically just the cost of the actual care. So if you're actually looking at what income that you're losing, as well as potentially your partner's income, that loss could actually be a lot worse. So it leads on to our greatest asset, which what we like to think is your income. So often people will think their car, their business, their home, or something else is their greatest asset. But when we boil down the numbers, it actually comes back to being your ability to earn an income. So if we're looking at our stats, we're looking at the Australian Bureau of Statistics, person age 30, you're likely to work through to age 65. The current retirement age is a little bit longer, but typically we'd look at age 65. So another 35 years worth of work on a median income of about $65,000. So for most people, that's probably considered a little bit low, but the ABS stats is what it says. What we've done is we've said that the income is going to be 4% per year. Obviously, the inflation's been a little bit crazier over that in the last 12 to 18 months, but let's look at that over the next 30 years. So your earnings is to be nearly around $4.8 million on a $65,000 salary, not taking into consideration any sort of pay increase or any promotions, which I consider a pretty big number, a lot bigger than obviously your home. So most people's homes between $500,000 to $1.5 million. Their car, $10,000 to $120,000. There's not too many people that don't insure those two things. So why don't we insure our income? I feel that if you are at this webinar, you probably believe that is a good thing to do. But yeah, across Australia seems to be very underinsured, especially around their income. So it's definitely something we want to bring light to and make sure that we're all covered.
Great. So I'm just going to talk about the different types of insurance. So for dual income, no kids couples, these are the four main types of insurances that we would look at. So there's life, also called death insurance. There's total and permanent disability, which I'll shorten to TPD because it's quite long to say that whole thing together. There's income protection. So those first three you might have in your superannuation account. And then there's also trauma insurance. So we'll go into what these different insurances are in more detail. And I'll start off with income protection. So this is, as Trent mentioned, one of the most important because your ability to earn income can add up to millions of dollars in your lifetime. So how income protection insurance works is that it pays you a monthly benefit if you're unable to work due to injury or illness. And I specify that because it won't pay out if you're made redundant. So with income protection, the maximum that you can be insured for is 70% of your salary for most insurers. And with all income protection policies, there is both a waiting and a benefit period. So with your waiting period, you generally need to wait about 30 to 90 days from either the date of the injury or the date of the diagnosis of the illness, which has caused you to be unable to work, before you actually start receiving those monthly income protection payments. Then you also have the benefit period. So what that is you'll be paid your monthly income protection payment for the length of either your illness, your injury, or the benefit period, whichever one's shorter. So if you were to just be off of work for like 2 months, that's how long you receive the income protection payments for. But if you can't return to work, your benefit period can last from from 2 years, which is what you might have in your superannuation income protection policy, up until age 65, worst case scenario. And so we like to look at income protection to cover you. Worst case scenario, you can't return to work up until your age 65. Okay.
Then we're looking at our permanent disablement cover as well. So a little bit of echo there. Looking at our permanent disablement cover. So with our permanent disablement cover, this one would pay you out if you were to be never able to work. And how that is paid out, or what the definition says, is can two doctors sign off that you're unlikely to ever work again? So we do have 3 levels of definition and how disabled you'd need to be before you're getting paid out. So this is something that we would assess with you, what we felt was best for you, whether you're not working, your different occupation risks and things like that, about what you could actually get. So the 3 levels of occupation are your own occupation. Can you ever return and do your own occupation ever again? So your specific role that you do on a day-to-day basis. Next one is our any occupation category. So the any occupation category is what you typically have through your super fund if you had your permanent disablement through there. So your any occupation is, can you ever work in any occupation? So basically finding you any role in the open market that you could potentially do. And then our last one is our non-working, which is often called activities of daily living or home duties as well. So this one is basically if you're not working. So the activities of daily living include, can you bathe yourself, feed yourself, get yourself in and out of bed? Can you basically live and breathe without having a carer help you around? So often we'll look to go up the scale and try and get your own occupation where possible, because if you're not working in your own occupation, we don't want to be forcing you to be working in any other occupation that you don't want to do, something that you're probably going to get paid less doing and you're not going to enjoy. We want to make sure that if you're not working in your own occupation, you're able to get paid for that. So what we would typically cover with your permanent disablement is we want to cover your debt. If you are never able to work again, we want to make sure that you'll be able to live in your home all the way through to retirement and beyond without having to pay that down. What we're also looking at doing is replacing that income that the income protection isn't going to pay you all the way through retirement. So as Kat was saying, most income protection is around 70%. So we're looking at that 30% of salary through to retirement. And then what we want to do is cover your medical costs and any modifications to homes, cars, wheelchairs, or anything like that as well. So if you are to be permanently disabled, we're expecting some form of lifestyle change. So we want to make sure we're covering that as well, so you're not out of pocket. Some people will look at it and go, well, if my debt's covered, why do I need to have my full income covered? Well, if we're looking at potentially looking at your partner taking time off work, your bills getting more expensive as we've been through with different spinal cord injury and things like that, we want to give you as much chance as possible to make sure that you can live the lifestyle that you have been living into the future, albeit now being permanently disabled.
And there's trauma insurance. So this is the insurance that's most likely to pay out, because unfortunately, a lot of people will be diagnosed with a serious illness in their lifetime, which is things like cancer, heart attack, and stroke. And trauma insurance will actually pay out a lump sum upon diagnosis of the serious health condition. Now, I will stress that this is not based on your ability to work. So there's no waiting period like there is with income protection. Trauma claims tend to be the quickest to claim upon. And we all know someone who has suffered a serious illness, either cancer, heart attack, stroke, things like that in their lifetime. So that's why trauma insurance is so important. So how we look to calculate how much trauma insurance you need is, for one, we look to replace your income, so that 30% of your income that income protection can't cover. So if you need to take time off of work for medical treatment, things like that, you can have 100% of your income covered both through trauma and income protection for a year. We also look to cover your partner's income. So if you're in a way where you actually need help either getting to appointments, or you're still recovering from illness, so you can't really do much like helping around the home, your partner can step in and do more of that for you. And also they don't need to worry about still working, knowing that you're at home dealing with a serious illness. We also calculate funds that can be used for medical treatment costs, because unfortunately there are a lot of treatments that go beyond what will be covered through Medicare and private health insurance. And also, you don't want to just necessarily only be relying on the public health system, because public waiting lists for treatments can be quite lengthy, unfortunately. So that's trauma insurance. So move on to life.
And then we have our death insurance, going back on myself. But typically for double income, no children people, this is typically the insurance come with insurance policy that most people say, do I actually need it? If I am to pass away, what's my actual need? I don't have any kids. I need to make sure that they're getting through school and things like that. My partner could potentially obviously find another partner and look after themselves from there. So what we would typically cover with our life cover is we look to replace a part of your income for your deceased partner, so that if you are to pass away, they're not having to go to work straight away. They're able to take time and grieve, and then over time actually live out their similar lifestyle, so they don't have to completely uproot their life and go, I need to figure out exactly what I'm going to do. Now I've only got one income as compared to our two. How am I going to live the same lifestyle as I have been previously? We'd also like to cover debt as well. So the reason for that is most people's mortgages are usually taking on two incomes at the moment. So we want to make sure that if you are now a single person, we're not having to sell the home straight away to now be able to cover that debt. We also often look at a legacy. So if you do want to leave your partner, your nieces, nephews, your family, your parents, whoever it is, your best friend, your dog, you want to buy your dog a big kennel out the back, we can often look at that too. And then looking at your funeral expenses as well. So making sure that, your funeral isn't going to be a burden on your family. So life cover, relatively straightforward. The way it pays out is if you were to pass away or be diagnosed with a terminal illness. So typically our terminal illness is if you're given 24 months to live, that is considered what they have as terminal.
Okay, so there's 3 different groups of life insurance. I'm just going to go through what the different types are briefly. So group cover is likely what you would have through your super fund. It can also be provided by your employer. And so essentially the insurer is able to pull together the insurance for a larger group of people. So they can make the premiums more cost effective and offer you a default level of insurance without any underwriting. However, one of the drawbacks with group cover is that the insurer can actually change the terms of your insurance policies or even cancel them at any stage. So it's not like you're guaranteed to have that same level of cover throughout your lifetime. Direct cover, so this is the type of insurance that you might see in those morning TV show ads, or maybe during TV commercials during the middle of the day. And so these insurances are similar to group insurance in that the insurer can change the terms of the policy and also cancel them at any stage. Retail insurance is the final one. So that's what we mainly deal with as financial advisors. And you can only take out most retail policies through a financial advisor. So one of the key differences between retail cover and group or direct cover is that the policies are what is called guaranteed renewable. So what that means is that once you've applied for the insurance and your insurance is in place, the insurer can't actually change any of those terms. They can't make your policies any worse. They can't cancel them. All they can do is actually add benefits to your policies. And you're the only one that can actually cancel the policy. So we deal with retail cover, and all financial advisors are able to help you with tailoring insurance cover that suits your individual needs with retail cover. Yes, don't listen to Koshi and the cash cow. Great comment, Trent.
So next we'll run through a few common misconceptions about life insurance, a few myths we often hear when speaking to clients. So the first one is, wouldn't I be eligible for government assistance if I couldn't work? So the basic answer is yes, but the next slide will go through why we think that's not going to be sufficient for your needs. Typically, yes, you would be able to, but the maximum disability support pension, as well as the carer payment per couple, including all the supplements and everything that you could possibly receive, is around $41,704 per annum. And that would only be payable if both of you weren't able to work at all. So as we've been through before, an average income of $65,000 per year per person, 41,000 between two probably isn't going to cut the mustard when it comes to sustaining your lifestyle long term, let alone living out your best life either. You also need to meet an impairment rating requirement. So that impairment rating requirement requires you to be in severe level of an illness or a disability, which is relatively disabled. You're not being able to go to work anytime soon, and it's not very pleasant to be in that range. Conditions need to actually be diagnosed and reasonably treated. So if you are waiting for surgery or treatment, you're not actually eligible for this payment either. And you need to be stabilized as well. So if you are getting worse or your health could potentially get better, you're not eligible. So there is a lot of loopholes that the government have to actually not pay you out. I don't think it's their purpose of doing it, but it just seems to be that way, that it's pretty hard to actually get this payment until you are really, really in the red. And the last one is, if you don't meet these conditions and are able to get this disability support pension or carer payment, you are able to get the job seeker payment typically. With the job seeker payment, that is a maximum of about $16,000 a year. And you'd also have to be looking for work as well. So if you are in this situation and you're unable to work, looking for work is probably not going to be feasible because you aren't actually able to go to those interviews, do the work. So it's probably not a position you're going to be in either.
So myth number 2 is, if I'm unable to work, my partner's income will be able to cover our living expenses. So that might be a possibility for some people, but you also got to think, what extra pressure would that put on your partner? So your partner might be able to cover your basic living expenses that you have together, but you also need to consider maybe that might mean you may need to cut back on certain lifestyle expenses. Another thing is that you may be in a situation where you're so ill that your partner actually needs to take time off of work to care for you. So there's a potential that both of your incomes may be lost from just one of you actually being ill or injured. Another thing is, you may have additional medical expenses or even increased household expenses due to you being at home more. And finally, another big thing is that the goals that you have together as a couple, you may need to delay or even forego achieving some of those on only one of your incomes, or even on no incomes if your partner's needing to care for you. So that's one of those big myths. And it seems like
so our third myth that we typically have, and what we hear from a lot of government employees, like teachers is the main one. I have loads of sick leave through my work because typically when you leave another public school and head to another public school, your sick leave will remain with you. I have lots of sick leave through my work. Why do I need to take out insurances? If I'm unable to work, my sick leave will continue to pay me out. So the way we look at it is, if you were to change employers, your sick leave is likely to leave you. Unlike your government employees, business to business, your sick leave doesn't stay with you. Also with this one, it's not like we are our parents anymore, where you figure out what job you want to do when you're 15, you complete that for the next 50 years of your life, and that's done. There's not many people that will stay in the one industry throughout their life. So that staying in the same business is probably going to be unlikely. So what we like to do is make sure that we're well and truly protected for that. Often people will go, well, if my sick leave won't cover me, I'll have my permanent disablement as well. Well, how do we get to that stage before we're permanently disabled? What we can often do is we can incorporate longer waiting periods into our income protection to lower your premium, while mixing that with your sick leave as well. So your sick leave might pay you out for the first 3 or 4 months whilst you are unable to work. And then we have our income protection policy kicking in after that point, which is able to reduce our premiums for our income protection, making everything a lot better for you.
Okay, myth number 4 is, I don't need income protection if I have TPD insurance. So a lot of you may have TPD insurance in your super, but might not have income protection. So you're thinking, oh, TPD will cover me if I can't work. However, there is some things to think about. So the first of those being that, so Trent mentioned earlier that to be considered totally and permanently disabled, you actually need to have 2 doctors sign off on them agreeing that you'll never work again. And doctors they do try to be optimistic. So if there is any chance that you may recover from your condition, they're not going to sign off on you being totally and permanently disabled. Another thing is, if you submit a TPD claim, it actually takes an average time of about 5 to 8 months for the insurer to decide whether to accept or decline your claim. So that's a long period of time for you to be waiting without any income coming in. And finally, if you also have income protection, first off, you would be receiving that monthly income while you're recovering from your illness or injury. And then worst case scenario, you do end up becoming totally and permanently disabled. At least you weren't waiting 5 to 8 months for any money to come in, because you've had that income protection policy paying you a monthly benefit in the meantime. So yeah, they all are very important and work together quite well. Now we're going to move on to some case studies.
Yeah, so we've got 3 case studies already written up, but if anyone in the chat would like to write in any case studies they would like to speak about or want to hear about how their insurances will work in those situations and what we're trying to cover, fire them away. I might run through the first one whilst those comments are coming through, if we do have any, and we can run through any of those after we run through the 3 we have. So the first one is typically the one I speak about when I meet with clients, because this is one of the cases where you're likely to claim on all 4 of your insurances in one lifetime. So if you were to suffer a stroke, that is typically a claimable event for our trauma policy. So that's the first insurance covered. You're probably unlikely to be you're likely to be unable to work at that point. So our income protection is going to kick in. At some stage, you're probably going to become permanently disabled from that stroke as your condition deteriorates. And then maybe 5-10 years down the line, you're probably likely to pass away as well. Relatively comfortable talking about these sort of things every day. Done it for a fair while, so don't be alarmed if I'm pretty blunt with the way I'm speaking. So in that first instance where we're suffering that stroke and we're getting diagnosed with that illness, what do we need to cover? So what we would like to do is we want to cover those medical expenses first up, so that you're not out of pocket, making sure that everything is paid for in a timely fashion. The next part after that is we want to cover your own income as well. So your income protection is going to cover that first 70%. Again, we want to cover that remaining 30%. So typically we're looking at 12 months. So you can figure out over that first 12 months what you're likely to do, making sure that your lifestyle doesn't need to change. You just need to worry about getting healthy in probably the most difficult time in your life. After that, we also want to cover your partner's income. If you were to suffer a stroke, the likely chance is you're unable to look after yourself in a certain way. So we want your partner to be able to stay home, not have to earn an income, look after you, again, in their probably most stressful part of their life. Already mentioned the income protection down the bottom, so looking at covering that all the way through until you're either able to get back to work or until your benefit period ends up. So let's say that this is the worst and we're never going to get back to work, and maybe it's 2-3 years down the line that the doctors are actually declared you permanently disabled. Now at that point, our income protection is going to continue to pay all the way through to 65, all the time that you pass away. So with our permanent disablement, what we would like to cover is your debts. So we want to make sure that you're living in your own home, debt-free. And if you don't have any debts, what we'll often do is we'll incorporate an amount there so you can go ahead and purchase a property as well in a neighborhood that you want to, so that you're no longer renting, potentially getting kicked out of your home at times that aren't suitable, or being disabled at the same time. We also want to cover that remaining income all the way through to age 65 that your income protection is not going to cover. So that magical number of 30% again, all the way through to retirement. From there, if you were to pass away, what we're looking to do is typically we're looking at covering your debts, but we've already covered those with our permanent disablement, so that might not be needed. So what we're really looking at is a legacy covering your funeral, anything else that you want to do there. So the outcome from our insurances is we've been able to maintain your full income throughout your life, covering your medical expenses so you're not out of pocket, and allowing you to live comfortably in your own home without debt, even though you're not actually able to work and earn an income. We've also been able to provide to your family after you've passed away as well, making sure that, yeah, there is something there for them too. You're on mute, Kat.
I just want to mention, we did get a question from Matthew. Did we want to answer that now or wait till Q&A section? That's going back on.
Yeah, fire away and answer it now if you want, Kat.
Yeah, alrighty. Let me go here. So Matthew asked, does life insurance work like private health where you can get a family or couples policy? So generally we look at the life insurance would be owned by you. So it wouldn't be, you can't actually have a family or couples policy. You can have some insurance policies where you have your partner owning them, but generally from our perspective, we always recommend that you have the life insurance owned by you personally or through a superannuation fund where you are the life insured. So the insurance is for you. So yeah, it's not like private health insurance where you can get one health insurance policy and cover your partner and your children as well. It's individual, and the assessments for the insurance are also based on your own individual health and your income and occupation as well.
Yeah, and further that, like Danica said earlier, we're looking at distributing that money through a will and estate rather than cross-owning the policies where I own my partner's policies, or if she passes away, that money gets directed straight to me, and vice versa. We own it ourselves, and then through our wills, we're able to distribute that, basically making sure that if you do break up in the future, you don't own a policy on someone that you're no longer with, and that difficult part of making sure that we're now owning our own policies into the future and making sure that happens. It's far easier to own your own, deal with it through your will and estate, and do it that way.
Yeah. Good comment and good question, Matt. Okay, so let us go to the second case study. So with this one, we're looking at someone who is diagnosed with cancer, but they end up recovering in that time and they're back at work within 12 months. So how it would start off with this is initially your trauma insurance will pay out. So as I mentioned earlier, trauma insurance pays out on diagnosis, so it can be quite quick to get those funds. That will help go towards paying for chemotherapy or any other treatment that will be associated with recovering from that cancer. Then if you actually aren't able to work because of your cancer and the recovery that you're going through from it, your income protection will also kick in after the waiting period. And just remembering that the waiting period is from the date of diagnosis of your cancer in this instance. Once that waiting period has elapsed, you'll start to receive those monthly income protection payments going to you. And so also, as we mentioned earlier, with your trauma insurance, we look to cover the 30% of your income that income protection can't cover. So worst case scenario, you can't work during that 12 months. 100% of your income has been covered through the insurances. We would also cover your partner's income through the trauma insurance. So as I mentioned earlier, worst case scenario, you're having a really hard time recovering from your cancer. Your partner can be there to help look after you and also not have to worry about still going to work to keep things going while you're recovering from cancer. And so the outcome is that having the combination of the trauma and the income protection insurance has allowed the person with cancer to just focus on recovery and not stress about where the money's going to come from, and also giving the partner the comfort that they can step back away from work and not have to worry about still bring in an income while their partner's recovering from cancer. And so we've also covered being able to help towards covering your medical costs as well through the trauma insurance. Okay.
And our third case study is more on the other end of the scale of that illness where you don't actually become permanently disabled, but you just immediately pass away. So what we've got here is a cancer diagnosis that happens really fast and you don't recover from it and you actually just pass away before we're able to declare you permanently disabled. So what we're looking at doing in that first instance is exactly the same as what Kat just went through. We're looking at covering your income through your income protection whilst you're unable to work, as well as that trauma payment instantly to cover your illnesses or the expenses attached to your illnesses, your partner's income and everything like that. But what we're also looking to do with our life cover is looking at covering those debts. Because we haven't become permanently disabled, our permanent disablement cover wouldn't have paid us out. So you still need to be declared permanently disabled. And that's why we think life cover is very vital for double income, no kids individuals or couples, even if you do have your permanent disablement cover. So what we're looking to do there is covering the debts. So as we went through earlier, we're making sure that your partner is able to live in your home and not change their lifestyle too much for that first instance. Looking at leaving a legacy potentially and covering any funeral expenses with that as well. So outcome, we've covered your income and medicals whilst you're still alive, leaving your partner with no debt, maybe a legacy so they can take time off work and grieve, as well as not have to move out of their home if they can't service the debt on their own instantly. As you're never declared permanently disabled, it would never have paid out, meaning your life cover is really important in this scenario.
Okay, so we will conclude with some final points. So one of these is, well, which covers should I take out? And my answer is going to be, it will be a combination of the insurances we've spoken about earlier. However, it's best to speak to a financial advisor because they'll help identify what insurances you need according to your individual situation. And they'll be able to tailor that according to both your comfort and how much cover you want, but also the cost.
So speaking of cost, how much does insurance cost? And it's probably the most common question we get when we speak to new clients. And it's the question that's nearly impossible to answer without potentially telling them a lie. So the reason for that is there's a lot of things that go into what your premiums cost. First one, obviously the amount you're covered for. If you're covered for $5 million as compared to someone that's covered for $100,000, the cost is going to be rapidly different. Your age is going to take into consideration as well as your gender. So different insurance is going to cost different amounts for different genders as well, because females are more likely to claim on their trauma cover, where males are more likely to do something stupid and claim something on their permanent disablement cover. Your occupation is going to have a big effect as well. Someone that is a stunt bike driver or a horse rider is going to have a higher risk than someone that works at a desk all day. So the risk in that's going to have a big difference, as well as your health factors. So what we'll look to do is to review your health factors. They're going to take into consideration your insurances as well. And each insurer will have a different view. So we want to make sure that we are giving you the best insurance policy for your individual purposes as well. So we don't just recommend one insurance company. We look across a wide range of different insurance companies as well. And at the end of the day, it comes down to how much you're willing to spend. We'll make a recommendation on what we think is affordable for you, as well as what's appropriate for you. But at the end of the day, you're the one that pays for the insurance premiums, and you're the one that receives something if something goes wrong. We want to make sure that what you take out is what you're comfortable with. So we'll give you all the information to basically empower you to make that decision for yourself. We'll tell you if you're making a silly mistake and you're reducing your cover far too much, but at the end of the day, I'll let you do it as long as you know the risks of doing so. We're happy for you to do whatever you want when it comes to your insurances, because at the end of the day, it's yours. Question and answers. So there hasn't been too many questions fired through so far, but do we have any questions from anything that we've gone through tonight or anything else at the moment? We'll answer them as they come through if we have any.
Yeah. Any questions about insurance at all as well?
give you guys a couple of minutes to fire them through, and if we don't have too many, we might keep moving on, but we'll give you a couple of minutes.
Yeah.
Awesome. Caitlin, can you, so I've seen Matt and Emily's question, but Caitlin, can you give me a few more details regarding the limit side of things? What do you mean by limits? Are you talking maximum benefit amounts, or what you're covered for, or getting paid out together? What's the limitations you're trying to speak about? But Kat, if you would like to answer Matt's question first, I'll try and figure out Caitlin's question.
Yeah, sure. So Matthew asked, what would be the benefits of applying for insurances now versus after having children? So, well, one of the first things that we mentioned earlier that's really important to consider is ensuring your income. So that's always going to be important to every person that works, no matter whether they have children, whether they have a partner or not. So that would be like everyone should consider having that. Another thing to consider also is with so when you go to purchase a home, you would want to ensure that you have your mortgage covered off, so that if something would happen to you in that time, you don't need to worry about the mortgage, not having to service the mortgage with either only one or no income coming in at all. I guess one of the big things to think about with applying for cover now versus waiting till after you have children is that something may happen and you don't know. Unfortunately, none of us have a crystal ball to know when something will happen to us. So I would just always be more conservative in trying to get the insurance that you need now. And then if you do have children come along later on, then you can add to your insurance later rather than waiting for something to happen.
Kat, and I'll answer Caitlin's question. So Caitlin asked, can you go through the different limits for policies and how they interact, e.g. TPD and life insurance? And then followed up with, I once looked into TPD and life, and the way they explained it was that the TPD was limited to the amount of life insurance chosen. So yeah, you are correct. A lot of the super funds will make you have a level of life cover that's equal to your permanent disablement. And the way the policies are structured they're linked together. So the way they're linked together means is they're going to limit your total benefit to be what the amount your life cover is. So let's say we had $1 million of life cover and $1 million of permanent disablement through our super fund. They're actually going to only pay you out $1 million no matter how you claim on it. So if you would become permanently disabled, it would actually pay you out the $1 million, but it would then vanish your life cover because you've been paid out that $1 million. And it's something we take into consideration as well. And when we're looking at, I'll scroll back through, but when we are looking at our 3 levels or 4 levels of cover with our stroke cover, and this is how I typically explain it in the meeting, is we are doubling and tripling up with our covers. So when we're looking at your trauma cover, we're looking at covering your medical costs as well as income that's lost. If we're then looking at our permanent disablement, we're covering the same thing. We're covering medical costs as well as income that's lost, albeit for a little bit longer through retirement. And the same thing with our life cover. With our permanent disablement, we're covering our debts, and that's the same thing with our life cover. So typically, if you are to go trauma cover, paid out, income protection paying you out, then our permanent disablement, and then our life cover, we typically don't need all 3 payments. But what we would look to do is go, if you want to leave a legacy for your life policy, we'll make sure that either we don't have them linked together or we have a higher amount of life cover, so that if you are claiming along that scale, that you do have something at the end there. So we do typically recommend to link them together because you do save on money by doing so, because we are limiting that total benefit. But yeah, you are right in saying that most of the super funds will not allow you to have a permanent disablement higher than your life cover, but some of the insurance companies that we do work with allow you to have what they call standalone permanent disablement or trauma cover, where if you said, I really don't need life cover, I just want to have permanent disablement or trauma cover, we don't actually need to hold that life cover as well, and we're able to access. Hope I was able to answer your question there, Caitlin. Kat, do you want to answer Emily's question regarding mental health?
Yeah, I'll answer that one. All right, Emily. So mental health exclusions. So the insurer generally places these upon policies. So I'll start off with what an exclusion is. So what an exclusion on your insurance policy means is that if you were to make a claim on your insurance policy and it was anything related to a pre-existing condition that's excluded, then it won't pay out. So if you have a mental health exclusion on your insurance policy and then you need to make a claim and it's related to mental health, the insurer won't pay out your insurance. Now, the reasons why you would end up getting mental health exclusions is if you've had any treatment or symptoms of mental health in the last few years. And all the insurers are actually quite conservative when it comes to mental health, in that if you've had a mental health care plan, if you've seen a psychologist, if you've taken any medication in the recent past, they will apply mental health exclusion. And it is something that is quite frustrating because a lot of people, as you know, during the last few years, during COVID and everything, a lot of people had a difficult time. So we do see that mental health exclusions are the most common exclusion amongst insurers. But one key thing to note is that a mental health exclusion isn't necessarily absolute. So you can review all exclusions and premium loadings as well on your insurances. And that generally can happen when you go a period of time where you don't have any treatment or any symptoms. So if you were to take out an insurance policy with a mental health exclusion and then had a period of time of, say, an average time is about 3 years before the insurer will be happy to review the exclusion. But if you're able to say, look, I've had 3 years where I haven't had any symptoms or any treatment, can I review this exclusion? They can remove that in the future. So just something to note, that they are quite common, but it doesn't mean that you're stuck with it for the life of your policy. So I hope that kind of answers your question.
Awesome. And I've got Danica's question. How often should you review your insurances? So another common question we have during our meetings, it's typically I would always look at every 2 years if nothing has seriously happened or nothing seriously changed in your life. So every 2 years I feel is appropriate, so we can look at your level of debts over time. You'll typically be paying them down. We can look at your incomes if they've changed, and your partner's incomes as well, making sure that we're still covering you for the right amount. So that review might be a 5-10 minute conversation and go, you're covered for the right amount at the moment, let's not change anything or reduce something or increase it. And what we also look at doing is reviewing anytime you've had a large change, whether you've had children, whether you've taken on a new mortgage, you've got a new investment property, you've taken on a new job, you've changed industries, you've got a pay increase, anything like that that's changing your financial situation, get in contact with your financial advisor. If the conversation is 5 minutes and says, don't stress, we don't need to change anything, or let's change it in 6 months' time, perfect. If it's let's change it now, even better. Reach out. It's probably going to be a 5-minute conversation most of the time to figure out exactly which way is going to be best way to go. Best to be safe than sorry, but I think every 2 years is probably a good idea to review your documents. Every year is probably a little bit too soon. You're looking at 1 year worth of debt. It's probably not going to be a huge amount unless you're pumping a heap of extra money into it, and no other financial changes. It's probably going to be too frequent, and you're probably not going to change too much. Awesome. Any further questions coming through? give you a couple more minutes to fire them off. Yeah, we've got about 7 or 8 more minutes left. We don't have too many other things to go through, just a couple more slides. All right, we'll keep going on to the next one. If anyone pops in any questions, we can go through them as well.
Okay, so how do I get started? So you can get in contact with either Tramp, myself, or one of the other Skye advisors on our website. So this is just the link that we have here where you can go in to book a 15-minute call with us. And that's just a complimentary call where we just go through what our process looks like. We also find out a bit more information about you and determine whether we can help you with your insurances. Please also follow us on socials. So we're on Facebook, Instagram, and LinkedIn, and we're pretty active on all those. And we like posting funny memes as well. So that's always a plus. And Mimi's put a link in the chat as well to make it easy for you. So you can always jump in there as well.
And our last one is, we'd love to hear feedback as well regarding this session and anything else we can do better. So yeah, we're always looking at getting better, and our webinars are something we've started and we'll continue to do into the future. So yeah, we are young in the process of making these, so we can always strive to do better. And the best form of communication is directly from the people watching it. Be as brutal as you want, be as honest as you want. I believe it is anonymous, so I won't be coming after you with a pickaxe if you don't like the sound of my voice. I'm more than happy for you to tell me that. If you can't do the feedback form tonight, when we send through everything, probably tomorrow morning when everything's been collated, you'll have a chance to fill it in then. The link will be in that email as well. So don't feel that if you are in a rush to go watch something on the TV or go to dinner if you haven't had dinner already, that you need to do it tonight either. But yeah, that's basically everything from us. Thanks for everyone that's joined us tonight and anyone that's going to be watching it in the future. Yeah, it's good to speak to you guys, and hopefully we hear from you guys soon.
Amazing. And thanks for the questions too. They were great questions, guys.
I love questions.
Yes.